Welcome back to the second part of topic 1.3, putting an idea into practice. Ultimately, we are going to keep going with our content. So in the first part, we looked at business aims and objectives, business revenues, costs and profits, and break even. If that is the content you wanted, please watch part 1 of 1.3. This video is just going to focus on 1.3.3, cash and cash flow, and 1.3.4, sources of business finance. So there's lots of little moving pieces with this video. We've got a few practice questions here for you as well. All right, so jumping straight into it, cash and cash flow. So the importance of cash. So one reason of the importance of cash is to pay suppliers. Suppliers are obviously those businesses in which they supply the business with stock or other things like ink for a printer and so forth. If suppliers not paid on time, then they might refuse to deal with the business in the future. So we're going to look at the relationships of suppliers in theme 2 again. This is why cash is important for our businesses. Now, the importance of cash, we need to pay overheads. So overheads, not always just fixed costs, but ultimately when we think of things like insurances and staff wages and rent and bills and things like that, advertising costs, they are the overheads of the business. So most of them are fixed costs. They don't generally contribute to the cost of making a product or performing the service, but they are things that the business still has to pay. So we still need to make sure that we are able to pay for all the things that we need to keep our lights on, to keep the business going. We obviously need to pay employees. So I mentioned before, so employees are a key focus. If we don't pay employees properly or on time, employees might leave the business, which will cost more to recruit new people. Also, it takes a while for new recruits to be working at the same level that previous employees were. But also, employees might get angry and start to take legal action against the business. It is unlawful not to pay your employees correctly. They have rights that they are protected, and it is the business's obligation that they can pay their employees. So the importance of cash is to prevent business failure, so insolvency. A lot of people, when they're looking at the BLTs, often they talk in their therefores, is that so the business doesn't go bankrupt. But going bankrupt is actually something that someone needs to file to go bankrupt. When we're really talking about it, we're really talking about business failure. So it's really important that you know the difference between bankruptcy and insolvency. So insolvency is basically when a business cannot afford to pay all their creditors. So their loan repayments, their rent and things like that. So they owe people money. The business can be put into liquidation and to be closed down, where basically all of the assets of the business is sold to pay off all of their debts. So businesses don't always go bankrupt. If they can liquidate all their assets and pay all their debts, then the business is closed, it failed, and people move on. Bankruptcy is something different. So we don't really have to worry about that, but I just wanted to make that really clear so you're not using those in your answers. So you can make it clear to your examiners that you know what you're talking about. That's the important part. So ultimately here, what we're talking about, the importance of cash is to prevent business failure. So if business runs out of cash, it may fail or become insolvent. The difference between cash and profit. Remember, profit is your total revenue minus the total costs in a business, or what is left once all the bills have been paid. So profit equals total revenue minus total costs. Cash is the money available in the business to pay the bills. Cash may not come in the same month as it goes out. So, for example, you might have a lot of bills that you need to pay this month, but you've given your customers 30 days to pay you, which means that money is not coming in until next month for you. So cash and profit are two different things, but just understanding where they function within the business is the important idea there. All right, first practice. So discuss the reasons why a business may fail. Discuss the reasons why a business may encounter cash flow difficulties. This is a 6 marker. So remember, we're looking for 2 BLTs. So in the question, it hasn't specified whether you're looking for advantages or disadvantages, but ultimately that you're looking for the reasons. So you need 2 BLTs for the reasons. So they need to be unpacked effectively. Pause the video here. And for the rest of us, let's keep going. So cash flow forecast is a prediction. So the reason we've got the picture of the weather map here is your maps are weather is predicted for you, so when it's going to rain and so forth. Because sometimes you notice it's predicted to rain on a particular day and then the sun comes out, the prediction was a little bit wrong. But the forecast is using because it's collecting the data and information that they have available to them, just like they do in a weather forecast, to predict what sales that they're likely to get. So for example, if they know that they're always busy every November, you can predict a busy November unless something else has changed that's happened in the market that they need to be aware of. So it's a budget for cash income and expenditure in a business, so you can generally work out when your sales or when your expenses are likely to occur within the next 12 months. It just helps with business planning. So cash flow is the relationship between money flowing into a business and the money flowing out. So I've got an example here. We're going to look at a festival as an example of what are the cash inflows and what are the cash outflows. So inflows will be things like sales revenue from tickets, sales revenue from store rents, and sale revenue from car parking. So this is all the things that a business is collecting the money on. So in this case, the festival, it's all the things that they're collecting the money for in their business. Your outflows are things like the cost of the bands, cost of hiring the site, having security staff, the cost of administration, and cost of accountants. When you've got lots of money coming and going, someone needs to be responsible for the money. So that's why you're obviously still having to pay for accountants to manage that money. So these are examples of cash inflows and cash outflows. So cash flow is a day-to-day running of a business budget. It shows where the business will have a shortfall of cash, so not enough to pay bills, and allows the business to organise short-term cash borrowing to cover the shortfall. The last part of this topic, we'll be looking at sources of finance, and these are the things. So there's an example here, but let's have a look in a practical example here. So creating a cash flow forecast. So your receipts are all your cash inflows, so the money generated. So when you think of receipts, what you should be thinking of the word is receive. So I know what we think of receipts as like a tax receipt when we purchase something like at the supermarket, but ultimately for the business, that is their receipt. That is the money that they have received, and that docket is essentially the evidence of what we've paid, but it's receipts for the business. So when you think of receipt, you think of receive. Payments is all of your cash outflows. This is all of your money spent. It's not payments that people have made to you. It's the payments that you have made that is going out of your business. Your net cash flow is your receipts minus your payments. Our opening balance is the cash at the start of the month. So if it's a brand new month and we're starting with 0, your opening balance will be 0, and your closing balance is cash at the end of the month. So let's have a little look at how that translates. So in this forecast, we're looking here that our receipts every month are where you receive £1,000. Our payments every month are £200. Therefore, our net cash flow is receipts minus payments, which is 800 in January. So because this in January it was the start, so it's 800 every month there. But we started with 0 in January, so that's our opening balance is 0. But therefore, our closing balance is your opening plus your net cash flow. So if you take your opening balance plus your 800, it leaves you with 800. But now that's our closing balance for January, that also then becomes our opening balance for February. So you can see there that it's already moved into the 800 there. So we know that our net cash flow for February was 800 as well. So our opening balance plus our net cash flow is 1,600. Then that's carried over again to our opening balance. So our closing balance is 1,600 for Feb, opening balance 1,600 for March, and so forth. And that essentially is how you do a cash flow forecast. So the idea is that you can forecast how much money you're going to have at the end of July. If you know basically how you performed in the previous year, you should generally be able to have it. It is an estimate. It is a prediction. Hopefully things are better than you've predicted, but it's a good way to know when you're going to have X amount of money, when you might be able to invest in new ideas and things like that. So opening and closing balances, these are shown on a cash flow forecast, which, as we've established, the opening balance is if the business has been trading, then it will be whatever cash is available at the start of the month. The closing balance is how much cash is available at the end of the month to be carried over to the next month as an opening balance. So note on a cash flow forecast that a negative amount would be in brackets. So this is way that you would visually see and express a negative figure is by putting that in brackets. So here's an exam practice. I want you to calculate the missing figure from the cash flow forecast below. So look at all the information there. This is for the month of June. How much is their total receipts? It's 2 marks. Pause the video and then we'll keep going. That was all of cash and cash flow. 1.3.4 is sources of business finance. This is a lot of little definitions and a lot of things to be aware of. It's really important that if you are answering questions in a exam about sources of business finance, that you're using the right types of finance to answer that question. As long as it's a valid type, you can generally still get your marks for it, but you need to think of the logic behind it. So the reasons for finance would be to pay for expenses like wages, as we sort of looked at before, expand the business, invest in new products and services, starting a new business, and paying for unseen costs. So when we talk about finance, we're talking about when your business doesn't actually have money per se, you need to be financed some way to pay for the things that you need in order to get your business off the ground. Choosing the right source of finance is going to depend on a few criteria. This includes how much money you're going to need, how quickly you need that money, what is the cheapest option available, what is the amount of risk that is involved in the reason for the cash. So for example, if your business has been performing badly and you just need money to pay employees, if you're borrowing it from a bank and the bank might kind of go, but why are you having cash flow problems in the first place? They might regard that as being a high risk. So, and then also the length of time that you need for the finance. So it all depends. So the right source. So amount of money. So if a large amount of money is not available through some sources and other sources of finance may not offer enough flexibility for a smaller amount, how quickly the money is needed. So the longer a business can spend trying to raise the money, normally the cheaper it is. However, if it needs the money really quickly, like if you had to pay a big wage bill, if it's not paid, it means the factory would close down, the business would have to accept a higher cost. So what we mean is sometimes there are some sources of finance where there's a really high interest rate, but it might only be, you might only need that for a short period of time. But if you need that money fast, the lender will charge you a premium on getting that money really quickly. And the cheapest option available, so the cost of finance is normally measured in terms of the extra money that needs to be paid to secure the initial amount. So generally, it's the interest that you're paying on that amount is generally how we measure the cost of that finance. But it can also be done in fees and so forth. But when we want the cheapest option available, when we're borrowing money, we obviously don't want to be paying too much extra money or it becomes harder to pay back. The amount of risk involved in the reason for the cash. So a project which has less chance of leading to a profit is deemed more risky than one that does. So potential sources of finance, especially external sources, take this into account and may not lend money to high-risk business projects unless there is some sort of guarantee that their money will be returned. And the last point there is the length of time required for finance. A good entrepreneur will judge whether the finance needed is for a long-term project or a short-term, and therefore decide what type of finance they wish to use. All right, so your definition for short-term finance is finance needed to cover the day-to-day running of the business. It will be paid back within 1 year. So we talk about these being, this is just more for incidentals, your short-term finance. It's just things that you need because you're paying bills. Maybe you need to quickly pay some employees, so forth, your short term. So when we measure short and long-term finance, it's generally between 1 year. So short-term is less than 1 year, long-term is over 1 year. So the three that you need to know for the course for short-term finance is overdraft, trade credit, and credit cards. They're all quite different, so make sure you know the difference between them. So overdraft, a business will have a current account with the bank. They will put in checks and cash and pay bills from that account. In the event of a cash flow shortage, a business may ask a bank for authorization to draw more cash for a short period of time. When you think of this, so other people, even non-businesses, can have an overdraft. I've got an overdraft from my bank account. Because it's the same account, it's not a separate loan or anything like that, it is your same everyday account that you can ask the bank to give you that little bit of extra money so that if you have no money in your account, that you can go into an overdraft, so go into some borrowed money. And it might just be for a small period. So for instance, for me, it's £200. If I've got no money in my account, I can still borrow £200 from the bank without having to apply for any additional request. It's just been added to my account. The idea is that once I get paid into that account, it will just automatically pay back that overdraft. The overdraft, remember, is the same account. So some months businesses may need extra cash to tie over, but a loan isn't suitable, because a loan is more of a long-term finance. So an overdraft is just a small amount they can borrow. Unfortunately, overdrafts generally have a really high interest charge, but the reality is because you're only borrowing a small amount for a really short period of time, you're probably not going to pay too much interest, even though the percentage rate is much higher than it would be on something like a credit card or a loan. So once an overdraft is arranged, so you could say it could just be £500, it's on a current account, you can dip into it and you can even pay it back on the same day. So it's really easy to set up. Here we go, some advantages here. So extremely flexible and can be like, you can set this up, literally you can call your bank and have an overdraft on the same day. Interest is only paid on the amount that you are borrowing, so the amount that you've gone into the negative, that's all you're paying for. So for example, if you were taking a loan, you're paying interest on the whole loan. The overdraft, you're only paying interest on the amount that you've borrowed. And you generally don't need any form of security on that to set that up. Now, the interest rate on overdrafts are normally really high, and banks can also demand immediate repayment on them. So they can just literally call you up and say, we're removing this overdraft, you need to get money and pay this back immediately. And they don't have to give you an overdraft. It's at their discretion. So these are the disadvantages of an overdraft. So trade credit is an arrangement between two businesses. So a supplier might offer trade credit to a customer. This means that the customer can take the good before they have been paid for. So this is a source of short-term finance as it postpones the payment for goods. So the seller normally gives the buyer 30, 60 or 90 days to pay, but ultimately the buyer actually has time to sell those goods before needing to pay back. So they essentially could be making profit before they even had to pay for the expenses. The wholesaler might give the buyer a discount if they just use cash instead. So if they don't pay for it on trade credit, they might get a discount if they just pay up front for the goods. But ultimately, they don't have to pay any interest on it because this is just a payment arrangement that's being made. It doesn't really involve the interest. So the advantage is the business will never run out of products to sell. If they've got a good relationship with trade credit, they can buy all of their stock on trade credit. The business can then sell the products and then pay the supplier. So they never actually have to raise finance for the goods, which means they never actually have to get a bank loan or anything to raise money to buy those goods if they've got a good arrangement with the supplier. Disadvantage of this is that the supplier may charge a higher cost for the products because of the credit arrangement. And if this is the first year that the business has asked for trade credit, the supplier might say no. So the idea is that, again, it's kind of like a line of credit. They may go, all right, for this first year, you spend up to $1,000 worth, £1,000 of trade credit at a time. So this means you might get £1,000 of stock. When you've paid it back, you can then borrow another £1,000 and so forth. If you have a good relationship and you always pay it back on time, and the supplier doesn't give you any reason not to trust you, they might give you a bigger allowance. They might say you can buy up to £5,000 of stock at one particular time. But they don't have to give it to you. There is no obligation. They can discriminate one customer against the other. There's no rules about it, but it's just a form of it creates a good business relationship if businesses are good. So they keep their customers happy and they keep their suppliers happy. So credit cards are a type of payment card in which charges are made against a line of credit. So a credit card is just a line of credit, regardless that you know it as a plastic card. Ultimately, it's saying they're giving you, it's essentially a loan of £10,000 that you can borrow against, and you have to keep paying that back. But you can keep borrowing up to £10,000 at a time. So when someone uses a credit card to make a purchase, that person's account accrues a balance, and that must be paid off each month, or at least a payment must be made each month. So you can have money owing, but you cannot exceed the amount that line of credit has provided for you. So in my scenario, you can never exceed owing £10,000. Advantages is that you can build a good credit rating or score, which will make future borrowing better. So if you want to make bigger loans for bigger business expansions, credit cards are good for that. Often credit cards can come with a rewards program like airline miles. So for example, if you travel a lot for work and you're putting that all on your credit card, you might then end up getting free flights through your business, which can be used for business. So there's a cost saving as well as a benefit. And reliably paying off the debt each month could result in your limit increasing. So if you've got a $10,000 limit, you might spend £6,000 or £7,000 each month in your business on it, and you pay it back in full every month. The credit card company or the bank might increase your limit to £20,000. So you've got more money that you can spend as far as that. Disadvantages is failure to pay off the credit card on time could result in interest charges and late fees. failure to pay this off could lower the holder's credit score, which can affect future borrowing, which means you might not be able to get loans and stuff in the future if you don't treat your credit card well. And also, when you don't pay your credit card off in full every month, the interest charges get really, really high. And that's more and more costs for your business, even though you're not actually spending more, it's just accruing more costs. These are disadvantages of that. So, have a practice question. Explain one benefit to a business using an overdraft. This is a 3 marker. Just think of one benefit of using an overdraft and BLT that. All right, pause the video here. Everybody else, let's keep going. Okay, now for our long term. So long-term finance is money that is needed for long-term projects that will pay back over a longer period of time. So longer than 1 year. So when we think short-term, there's things for the day-to-day running of the business. Long-term might be for larger investments, expanding products and things like that. So maybe you want to build a new factory, maybe you need to expand the business, you need more staff, you need more products and so forth. These are your longer-term finances. So personal savings is considered a longer-term finance because you may have been saving over for this finance, you might have saved £50,000 over the last 10 years, and you actually invest that into your business. So, or it might be you might have won some money or you might have been left some money, but these are all personal savings. So it's still a form of finance and you put that into the business as the business equity. Advantages of personal savings is it's easy to access the money because you've got the money already. You don't have to do any complicated paperwork because you're not applying for the money, and you don't have to pay interest because the money's already yours. Now, the thing is, if you've been saving £50,000 because you wanted to buy a house, well, you either have to decide whether you're going to not spend that money on your house and invest it on your business in the hope that your business will make more money in the long term. But that's the opportunity cost when you spend money on one thing and not on the other. The next long term we're going to look at is venture capital. So venture capital it's essentially a loan for a business, but it's from a private individual and not a bank. Now, the individual who lends the business money is called a venture capitalist, and the venture capitalist may wish to help run the business in order to protect their investment. So sometimes they treat it not as a loan, but they invest X amount of money into the business, and they actually ask for a share of the business. So you're actually selling them a piece of your business rather than it being a loan. But that is the individual terms of that venture capital arrangement that you go into. So advantages are venture capitalists can bring knowledge to the business and help it expand. They take on high-risk businesses. So generally, you would never normally use venture capital when you're looking at what is for a long-term finance option. When it's a big company in a case study in your exam, you're not normally going to do venture capital because generally a big company already has alternative options of what they would be eligible to borrow money from. Venture capitalists normally help a lot of startup firms. So they're looking at riskier businesses. So they can help by providing the business's growth capital and strategies. Now, the disadvantages of venture capital is that owners may lose some of the control of business. Owners may have to give up a large share of the profits to the venture capitalists, and venture capitalists may require a large share of the business. So just as a point of reference, if you think about The Dragon's Den, the TV series, that ultimately they are venture capitalists. So they might invest in a business and they might get asked for 40% ownership. And what that 40% ownership would mean, for every £100 that your business makes, they get £40 of it. So that's quite a lot, especially when you're the one who's put in all the work to get that business off the ground. So this is the risk of venture capital, saying that they are business people themselves generally, and they obviously, because they're investing in the business, especially if they're taking an ownership of it, they want your business to make more money, so they will generally help that business get off the ground. So the definition of share capital. So this is something that a lot of people get confused in their exams. It's really important to understand share capital. So limited companies can issue shares in return for money to raise funds to grow or expand. The private limited companies are they're also with the prefix of LTD. They can issue shares to friends and family of the owners. So both public limited companies and private limited companies can generate shares, but public limited companies can float the share issue on the stock market and sell it to anyone. So people like you and me, when we buy shares, shares are an ownership piece of a company. So just remember that, that when there's a shares, we're talking about a shareholder is a part owner of a business. So ultimately, when you're raising share capital as a form of finance, you are selling pieces of ownership of your business. So advantages of share capital is the advantage of raising money in this way is that you don't have to pay back the money to the investors because they're investing, they're getting an own piece of ownership of the business. There's no loans to pay back. It can attract new finance, so people who are looking to invest in new businesses they're already invested in your business, but they want to invest more. It acts as an incentive for staff. So sometimes employees in a company, instead of getting bonuses, they'll get shares of a business. And it's a great way to raise your business profile. Disadvantages, shares represent ownership of a business, which means that when an individual buys shares in a business, they become one of its owners. Shareholders choose who runs a company and are involved in making key decisions, such as whether a business should be sold. So this means when you're a private limited company or a public limited company, you don't own the company anymore. You might have shares in the business, but as more and more share capital has been raised, your ownership of that company is getting smaller and smaller. Now, once you don't own less than 50% of the company, your shareholders can vote to have you removed from the company. They can choose a different director for the company, and they can even choose for that company to be sold off. And that might be the company that you've created, but you don't have that control anymore because the rest of the owners get a say. So that is what share capital does, but it's a great way, if it's a valid company, it's a great way to generate more money of people investing into the company. So the idea, as long as when your company is performing better, each share of that company is worth more money. So that's the whole idea. So you want things to be good and people will pay more for a smaller amount of the pie. So loans is our most common form of long-term finance. So loans are issued by banks. Banks might require some security. So for example, when you take out a mortgage, you're generally taking out a 30-year loan, and they actually have the house that you've bought as the security for it, which means if you don't make your repayments, they can come and take that house and you get no say about it because they own that security, even though you're the owner. And that's the idea of what happens with loans is some loans they will take a security for. Same thing in business. They might, if you're taking a loan to buy a new factory, they might own the deed to the factory. And so forth. The loan will have interest, which will have to be paid back to the bank. So advantages of loans, a medium to long-term business loan can help with all the costs of setting up business from expenses and paying staff. The longer the term of the loan, the lower the monthly payments will be as they're spreading the cost over a longer period of time. If you borrowed £10,000 to set up your new business and you want to pay it back in 1 year, that's you're going to be paying back like probably close to £1,000 every single month. And if you don't have any customers, £1,000 every month is a lot of money. But if you had that loan over 3 years, you might have been paying back £400 every month, which is much more manageable. But over the time, you're probably going to pay more in interest over that 3-year period. But the advantage is that your payments each month are much more manageable. Disadvantages, the amount of interest you must pay on a business loan will depend on your individual circumstances, including how much you want to borrow and over what period of time. That was what I was talking about. If you borrow X amount and you want to pay it back over a longer period, although it's good that your payments are smaller, you're probably going to pay a lot more in that time period. Each month, the business will have to pay back some of the loan regardless. Even if they've had a bad month, even if you made no sales, you still have to keep paying back that loan because that's the arrangement that you're in. So you've made that commitment, you have to keep doing it, or it can affect your credit rating and things can go bad. We're almost at the end here. So retained profits. So after a year more of trading, a business may have some profits they're able to reinvest into the business to help it grow. This is called their retained profits because the business retains it. So the difference is when we look at profits, these are the profits that you have left at the end of your revenue minus your expenses is your profit. Let's say your profit is £10,000. You might say, I'm going to put £5,000 into retained profit. So that's basically putting £5,000 back into your business, and then the other £5,000 divided up between all the owners. So if there's 10 shareholders in your business, each of them will get a portion of that £5,000 left, and ultimately you've got the rest of that £5,000 to invest in your business without needing to raise more money because you've got those retained profits. So you can invest in new ideas. If you're in your first year of trading, you're not going to have any retained profits because generally it's at the end of your trading year is when you look at how many profits you have to determine how much you want to invest back into your business. Cool. The advantages, no interest to pay on the loan, like savings. It's the cheapest method of finance. You've got access to the funds quick and easy because you've got them sitting in your business account. If it's spent, then it can't be used for any other purpose, like we talked about the opportunity cost before. So if you invest and buy a new machine for your business, you can't buy a new company van to deliver the goods and things like that. And again, not applicable in the first year of trading, as no profits there. So one of the last ideas here that we've got is crowdfunding. So it's the practice of funding a project or venture by raising small amounts of money from a large number of people, typically via the internet. So there are websites people have put out their business idea and basically try to get people to invest in their business. It is a great way. I know people who have started their own ventures through crowdfunding and they've been successful. So some advantages might be the only way that some small business ideas can get funding. So if you've been turned down for a bank loan, might just be because you're young or because you didn't write a good business plan or so forth. For whatever reason, you weren't able to generate the money in another way. Crowdfunding, other people might see value in your idea. It also acts as an advert for your business, so people start to know that your product is going to exist. So if you've got something really niche, it's a really cool way to attract people and to attract funds. And it also helps keeps your fixed costs to a minimum because you are being really careful, because you can only get X amount of money through the crowdfund. That's hopefully you are managing that money really well. Disadvantages is you might think it's a great idea, but nobody else does. So you might not attract any other investors. It might be a waste of time. You could spend a lot of money trying to get a crowdfunding idea off the ground and ultimately nothing happens. But also, because you're putting yourself out there, you're also letting competitors about your need for the funds so that they know, but also be sharing your idea out with a lot of other people, and people can steal your ideas. So depending on how niche it is. So having a patent in that case would be a really good idea. All right, so for the questions that we had for sessions today. So discuss the reasons why business may encounter cash flow difficulties. So this was a 6-marker. So we've got our 2 BLTs. One reason may be due to seasonal demand, because they may be selling something that is only needed during certain times of the year, e.g. Christmas decorations. This leads to the business not making many sales of the items throughout the year, therefore may not be able to pay all of their ongoing costs throughout the year, resulting in cash flow difficulties. Another reason may be due to poor credit terms with their suppliers and customers, because they may need to pay suppliers in cash and give their customers time after their purchase. This leads to instant cash outflows and delayed cash inflows. Therefore, the business has poor cash flow and increased risk of bad debts if some customers don't pay. This, you can have many different types of answers. You just need to look at 2 reasons why a business might have cash flow difficulties. Next question. Calculate the missing figure from the cash flow forecast below. So if we know that net cash flow equals total receipts minus total payments, so total receipts is net cash flow plus total payments. Therefore, your total receipts is £35,000 plus £105,000, which equals £140,000. So if you remember there, if you then put in the 140,000 minus your 105, that equals your 35. So that's what all you're basically doing is reverse engineering. You're plussing the 35 to the 105, and that leaves you with the 140. Next question. Explain one benefit to a business using an overdraft. The business will only pay interest on the amount of overdraft they use. Because it will mean that if only a small amount of overdraft is used, then total repayment will be lower than using other forms of finance. Therefore, it keeps the borrowing costs low. All right, that is the end of 1.3. I will see you for 1.4.